A very warm welcome, everyone. My name is Axel Threlfall. I'm editor-at-large at Reuters, based out of London. I'll be your moderator for today's webinar. Net zero targets closer than we think. Is the energy sector on the right track? Is our, I think, quite bold title today. The webinar is hosted by the Al-Attiyah Foundation in partnership with Refinitiv, an LSEG business. Just before I give a very brief scene setting, let me quickly go over a few housekeeping bits. For the best viewing experience, read the instructions above the media player. It'll give you everything there. For any technical issues during this webinar, refresh the page or reach out via issuerservices@lseg.com. For any questions you have, do click on Ask a Question, and I will do my best to weave those questions into the conversation as we go. So do send them through throughout the presentation. I'll be posing several polling questions. Do respond to those. Let us know your thoughts. That's always extremely useful. And finally, the recording of the session will be available using the same link. So very quickly, our context, according to the UN's Intergovernmental Panel on Climate Change, in order to limit global warming to around 1.5 degrees, as called for in the Paris Agreement, GHG emissions need to peak by 2025 and fall 43% by 2030. At the same time, CO2 emissions need to reach net zero globally in the early 2050s. Despite bold pledges and efforts by government and business, CO2 emissions from energy and industry have increased by 60% since the UN Framework Convention on Climate Change was signed in '92. The energy sector, as the biggest single GHG emitting sector, has, of course, a pivotal role to play in the transition. That's got to involve fundamental change, more efficient energy consumption, a huge decline in the use of fossil fuels, rapid deployment of available clean energy technologies, and widespread use of technologies that aren't yet on the market. But the road ahead, as we all know, is a very hard one. Wide-scale adoption of renewable energy is still a long way off. The global energy mix still dominated by fossil fuels, and about $4 trillion a year needs to be invested in renewable energy until 2030 to allow the world to reach net zero emissions by 2050. So that is a little bit of context. And with all that in mind, those who feel that our title question, is the energy sector on the right track, is a far-fetched one, might well be forgiven for thinking so. Key is what we mean by the energy sector being on the right track. And we will we'll put that to our panelists in just a second. This is the first webinar of our 2023 series that will address that question and many other important questions. Let me introduce the panel now. With us today, we have Patrick Allman-Ward, Chief Executive Officer at Dana Gas Group. Ibukun Adebayo is Group Director, Head of Strategic Initiatives, Sustainable Finance and Investment at the London Stock Exchange Group. Juan Vasquez, MD and Partner of the Boston Consulting Group in Qatar. And Dr. Masamba Thioye, Project Executive of the UN Climate Change Global Innovation Hub. A very warm welcome to all of you. This is a really super panel we've pulled together. Just before we get stuck into that discussion, I would like to invite Ibukun from LSEG for a short presentation. Ibukun, the floor is yours.
Axel, many thanks. And I'm absolutely charmed at the way you pronounce my name, Axel. I'm sure you've possibly been to Nigeria before, maybe even grown up there. Super pronunciation. It's my pleasure to be here and to be here with a group of esteemed panelists. I'm just going to give a very brief overview in terms of some of the global renewable energy trends, and particularly in relation to net zero. But before I do so, I just really want to make a quick statement with regards to LSEG. We are very much at the heart of global capital markets, financial services and data, and really look at different innovative ways around sustainability and facing some of the challenges squarely that society faces. We're committed to being an enabler of sustainable growth. And in that sense, we've got our own science-based emissions targets, and our goal is to reach net zero by 2040. If we could go to the next slide, please. So I think Axel has outlined some of these numbers, which we can see here on the screen right now. So the big numbers, $4.8 trillion needed on an annual basis to get us towards net zero across all forms of capital and infrastructure. And the number, very interestingly, on the energy side is, or at least the electricity production side, is about $1.6 trillion on an annual basis to 2030. It's a significant number and a significant challenge. And what I want to demonstrate in some of the stats that we see moving forward is where we are and how we're getting there and proceeding there within the current realms of financing capacity and constraints. So we go to the next slide. Apologies in advance for these very, very busy slides. What we can see here is the global renewable energy project financing. And essentially last year, $573 billion came into the industry. So that's financing everything from solar to nuclear to wind, geothermal, across all of the global renewable energy verticals. Within that, the capital need, so I'm just going to draw your attention very quickly to the chart on the left-hand side. So Rook, if we go to the left-hand side, you can see in 2022, the actual financing requirement was just over $500 billion, $573 trillion. But in terms of actual projects that were financed, we were more at the $344 billion. So quite a sizable gap in terms of deals that have been announced and deals that have been financed. And that trend continues across all of the verticals. And the reasons for this primarily are due to COVID slowdown and essentially capital not flowing quickly enough to reach the real economy. So uncertainties like the Ukraine wars made investments in that space much riskier. And obviously things such as higher metal prices and input prices, China's struggle to return to normality has driven up the costs as well. So we're seeing that this volatility, or this gap, as it were, over time is creating more consternation. So there needs to be a number of different types of financing options, really, to create the, or rather to remove and alleviate the gaps and the issues. So if we go to the next slide, let's have a look at what's happening in the sustainable debt capital markets. So traditionally, energy infrastructure has been financed by loans, bank debt, that type of financing, obviously off balance sheet for larger companies. But what we're seeing now is the increasing trend and the opportunity to use sustainable debt capital markets. So, for example, green bonds, sustainability bonds, and sustainability-linked bonds. And we can see some very healthy numbers helping us to bridge those gaps that we were talking about previously over the last few years. And in fact, the increase over the last 5 years has been a 57% increase in global sustainable bond markets, which again is very important to in terms of meeting the net zero recovery opportunities. Now, there still is a lot to do. As we can see, there are still issues around elements of greenwashing. What is the, what are the definitions of greenwashing? Does it prevent asset managers from investing into instruments such as this? We think it does improve that environment a little bit. Green bonds, sustainability bonds all have to be certified and on an annual basis to ensure that the veracity of the investment. And new rules that are coming in around various taxonomies, but also regulation across all jurisdictions. And elements such as TCFD are helping and increasing the confidence in these types of instruments. So if we can go to the next slide. Really, in conclusion, the two big numbers to look at here is that still the renewable energy projects in particular are still not being financed in totality by sustainable types of financing, such as green bonds, sustainability bonds. 10% was the number in terms of capital supporting those energy mixes. and 13% in terms of number of projects. So what needs to happen in order to try and alleviate some of these problems? So those market challenges that we refer to there needs to be a continuous advancement of these international standards and frameworks that are creating these gaps for investment. And I believe as time goes along, we will see the alleviation of that. But overall, generally, there is a lack of data, ESG inputs, as we like to call them, and a lack of diversity of methodologies, in fact, apologies, the diversity of methodologies, which are again slowing down the engagement with the buy side. And then the final point to make here is around some of the regulatory requirements, which don't always meet some of the challenges that we meet globally. So for example, asking companies or institutions in some of the developed markets to meet standards such as TCFD will be a challenge moving forward. So we are very keen to see how these some of these challenges that we've described here can be discussed in this panel session later on. But at this point, just giving this overview, Axel, I will pass back to you. Thank you.
Thank you, Ibukun. A great way to start, actually. And look, before I bring up the first poll, which is a broad one, I want to throw this quickly to Patrick, because I know this will have been of interest to you, Patrick. I mean, at the end of the day, Patrick, it's all about convincing investors you can run renewables projects profitably enough to compensate for losses from the fossil fuel business. I guess at the end of the day, how hard is it to do that?
Well, very hard. We've had a couple of bad years in the oil and gas industry, but traditionally, oil and gas industry generates rates of return of 15% to 20% or so, and generally renewable investments generate utility rates of return. So that's usually sub 10 and usually more around the 5-6%. So there has been a post recovery of oil price and gas prices, there has been a recalibration, if you like, amongst the investment community that they actually rather like the higher rates of return that the oil and gas industry can generate, and are struggling a little bit in balancing their portfolios if they put too much renewables in it. Now, we need renewables. We need as much of it as we can possibly get. I'm a geologist and I'm an environmentalist, so I'm absolutely for the renewables industry. But the challenges that Ibukun has identified, and I did spend 3 years in Nigeria, Ibukun, that the challenges are financing-wise are significant, and the multilaterals, of course, have got to step in and take a role here in order to facilitate further private investment in the sector.
Yeah, and look, we'll draw that out as well. I want to speak to Masamba about the multilaterals as well, and look at the COP process. Look, before we really get stuck into the conversation, let me throw the first polling question out there just to get our audience engaged as well. Here is the question: which of the following pathways will make the most substantial contribution towards achieving net zero emissions by 2050? Is it A, an energy sector based largely on renewable energy, as we've just been discussing, B, a huge decline in the use of fossil fuels, or C, clean electrification of most end uses of energy? Those are the three options, and I'll bring the results up just as soon as they come up. But Richard, Patrick, let me stay with you, because I raised this issue of the title. And my question to you is, what does it mean for you that the energy sector is on the right track? Could the sector be on the right track, Patrick, but still have global emissions trending flat or even rising?
Well, let me start, Axel, by saying that we're way off track. I think when the global stock takes place in Dubai in November of this year, we'll realize just how far off track we really are. So we're not anywhere near where we need to be, and we need to really double down on our efforts. But I would like to also take the opportunity to say I don't believe in an either-or world. I believe in an and world. And just to give you a sense of the challenge that we face, if we were to reach the 1.5 degrees target by 2050 through elimination of the fossil fuel industry, I'm talking here specifically about oil and gas and not coal, you will need to see a destruction of demand for oil equivalent to the destruction seen in 2019, 2020 through COVID every year for the next 20 years. And you'll need to see the destruction of demand for gas equivalent to the amount of gas that was taken out of the European market from Russia last year, every year for the next 20 years. So I have to ask you whether those, that approach to achieving net zero is really realistic. And my position, obviously, as CEO of a gas company, is that it's not realistic. So what we really need to talk about is decarbonization, and not the elimination of fossil fuels. We're simply not going to get there with the elimination of fossil fuels. And people have shown and voted very clearly that they don't like not having power. They don't like not having affordable power, and they want their power 24/7, 365, and not 35% of the time, which is what renewables can deliver.
And look, that is what you've just said is reflected in that first poll, the results of that first poll, because a huge decline in the use of fossil fuels is number 3 out of those 3 options. So, but most important, an energy sector based largely on renewable energy comes at the top. And again, reflecting very much what you said. Masamba, let me bring you in here. We heard Patrick talked about the global stock take that we'll see in Dubai. It started, of course, in Sharm. Where does the energy sector feature in that assessment? If there was an energy stock take, what would the energy stock take look like as far as you're concerned?
Thank you, Axel, and good morning, good afternoon, and good evening to the participants to this webinar. The detail of the global stock take are still to be determined by parties of the UNFCCC, as the UNFCCC process is a party-driven process. Therefore, what I will be sharing here is just my expert view, what I think could get out of the global stock take and how the energy sector could be positioned in this global stock take. So the energy transition is critical to the achievement of the 1.5-degree goal. Therefore, the energy sector is expected to be given a prominent space in the global stocktake. So the global stocktake will be an assessment, but it can also be facilitative. So the assessment part is what was described by Patrick. It will be somehow backward-looking and compare where we should have been now with where we are. So applied to the energy sector, this will bring out the climate performance of the energy sector, where entities have underperformed. This will be critical to understand why, by determining the type of gap which is the driver of their underperformance. Is it an access gap? Is it that they do not have access to the means of implementation? Is it an ambition gap, or is it an availability gap? Is it that the solutions that they need to successfully be aligned with the net zero pathway are not yet available? So the suitable type of solution to address the gap will need also to be determined. But more importantly, you have also this facilitative part that will be forward-looking and is expected to compare where entities have planned to be in the future moving forward and where they should be in the future. And I think this is really the most important part, because this will allow us to understand what is the gap moving forward and what type of solution could be implemented to fill the gap. Here, you will be able to facilitate entities so that they become aligned, whereas in the first part is more about assessing whether they have done well or not.
Got it. Okay, Masamba, thank you for that. And I want to expand on that a little bit in a minute, but let me bring Juan in to this. Juan, yes, we need to throw this forward. Yes, we need to look at that gap. How will the energy sector look on the back of this stock take, do you think? And let me ask you, I mean, you of course have dealings with the corporates and with governments as well. Are the business plans on the corporate side that you're seeing, as far as you're concerned, putting in place the necessary steps to make this transition happen successfully?
So look, in a single word, yes. Okay, I agree that with what Patrick was saying before. Okay, I think we need to be realistic. Okay, so that they are putting the blocks in order to reduce and decarbonize their emissions, they are doing it. Okay, and there are a lot of investment done by the AOCs and by the NOCs on this regard. Okay, getting to net zero is right now technically, I would say, impossible. Okay, and it's where the offsetting comes and other measure comes. Okay, but they are taking the right steps towards it, considering also a realistic scenario where oil and gas, and this is my view, will continue being used. Okay, another thing is to get to this net zero. It's a combination of technologies. I heard a lot, about renewables. Okay, but this is just one angle. Okay, there are multiple other technologies that we need to consider to get to net zero. Okay, that companies are taking into account. Here in Qatar right now, we have the largest CCUS project that is being now developed and has taken FID, which will capture 11 million tons per annum, okay, of CO2 and put it underground. There's also the hydrogen, okay, which is also a new technology that's still very difficult to transport, but could be a technology to develop to transport and to be competitive. So it's something that, there are multiple technologies that would compete to achieve this. And in a plain answer, yes, companies are taking this into account, also taking this into their business assessment, okay, a CO2 price to define what is the impact of that they're having in the market.
Okay, and I'll come on to the technologies and which technologies excite the panel most in a moment. But generally speaking, Juan, is the sense you're getting from the companies you work with that they can make profits with renewable investments in the, I guess, immediate, slightly further out midterm?
So it depends a bit on the market. Okay, I think that there are markets which are more competitive and the regulation is there. I heard Ibukum before about the lack of regulation. There are markets that the regulation is already in place. And the problem here is, as Patrick was saying, the IRRs that you get from this are very, very low. Okay, so it's 6-7%. So the incentive of companies to develop it is, I would say, much limited. Okay, then in new markets, yes, the IRR could be higher. Okay, if you go, I don't know, to Southeast Asia, there are several markets there where the IRR of some of the renewables could be above 10%. The problem there is the risk, the regulation. Okay, that it's an investment that you do for 20 years, and I would say the stability is not there. So this is why you have a higher IRR. In essence, doing renewables technically is very easy. Okay, so this is why the IRR is lower. So it's not the same doing developing an oil and gas field in Mozambique, okay, an LNG field in Mozambique, and doing solar panels in Spain. I own a solar panel in Spain, okay, and I don't own a oil and gas field, unfortunately.
Look, before I bring it back to Patrick, Ibukum, let me just ask you. I know LSEG is heavily involved in the whole ESG piece, as everyone seems to be these days. How is it ESG driving change across the energy sector? Clearly, there's been a bit of a backlash. Maybe it's a little bit of a cliche to keep mentioning this backlash against ESG. But give us some of the best practices that you've seen and how this is moving the process forward.
I think, look, right now this is a construct of all of the strategies of all IOCs and NOCs. Okay, the ESG is not a side thing that has been taken on the side now. In all the all the discussion that we have with them and all the projects, this is a fundamental part of their strategy. Okay, so look, I think that this is I read a lot of in press, like a lot of criticisms against IOCs and NOCs, but these are really changing. If you think about, I don't know, some of the European IOCs, okay, how they have changed their strategy, have moved from being an oil and gas company to become energy companies that they provide services.
Agreed. Yeah, and we've spoken to Shell and BP about this as well. But to you, Ibukum, what's your thought on the ESG piece and the way it's moving the process forward?
Yeah, and it's a very interesting question. And I think the first thing on this is to recognize the fact that now this is very much an investor question. You know, about a third of global AUM, about $50 trillion, has some form of ESG mandate associated with it. And ultimately, I think what we're now trying to, or what's happening in the energy sector is it's able to play in this space on the basis that there is a very key distinction that's required here, which is the fact that you have your ESG inputs. This is where an asset manager takes its decisions on risk-adjusted returns of an asset based on environmental, social, and governance issues. And then you have your ESG output, which is how I suppose most people traditionally think about ESG, which is what's the impact on environment, what's the ethical compass. And from a PR perspective, you know, it's important for those investors to invest in companies that don't burn coal, or they eschew nepotism, or indeed have diverse executives. Now, both of those are ESG factors. But what's happened now with this development of this ecosystem of the movement, if you like, is that a fund manager can still potentially invest in a heavy carbon emitter if it states categorically that it's using ESG factors to assess its risk-adjusted return, and particularly if that investment falls into some sort of well-defined transition strategy. But all of these elements are only going to be possible in terms of more capital coming into the energy sector if there is more data and disclosure. And ESG data inputs are key. Asset level data in particular, physical risk, whether it's structured or unstructured, is going to be the key to broadening transition finance in this sector. So I'm not going to sort of draw on one particular best sort of practice example, because there are lots of them. And I think we're seeing that there is definitely an option and opportunity for energy companies in that ESG space moving forward.
Okay, very good. By the way, send your questions through to our viewers. Send your questions through. I'll do my best to get to weave those questions in. Patrick, how is Dana Gas doing? When looking at our title, how do you feel Dana Gas is doing? And is a lot of your time, maybe this is a leading question, but a lot of your time spent feeling a little bit frustrated by mistaken energy policies or regulation that isn't even around the world? You know what I'm getting at, you know, this sort of shifting trilemma and prioritization of the three pieces. How are you doing, Dana Gas? And two, how bogged down are you by all of this stuff?
Well, let me put those questions the other way around, if I may, Axel, and let's deal with the policy part first. And you know, I think we're all committed to the target, you know, of net zero 2050 and a decarbonized world. I think the difference of opinion is how we get there. And yes, I am frustrated with poor policy decision making, particularly in Europe, and the demonization of the oil and gas industry. And I think we really do need to be honest with ourselves and realize that the energy, which was largely a gas crisis in Europe, started before the Russian invasion of Ukraine. And it was a crisis that arose from underinvestment in gas supply without addressing gas demand. So yes, I am frustrated by policy, because I think the policy at the moment is driving the wrong kind of investments in the wrong sort of directions. And by that I mean that we need more renewables. But as a result of those policy decisions last year, the European Union spent $500 billion in energy subsidies, which was significantly more than was invested in renewable energy, for example. So I think there's a lot of dislocation and misalignment in policy, and that is a frustration, because it means that it's increasingly difficult to get financing for new gas developments, for example. How are we doing in Dana Gas? I think the industry as a whole, you know, we were criticized, and possibly rightly so, for being a bit foot draggy in terms of climate change. That is history. I think every publicly listed company now realizes that ESG climate change is a license to operate, just as much as HSSE was 30, 40 years ago. You know, ESG and climate policy and managing that, making clear commitments to it is absolutely, you know, existential. And I see huge commitments in the industry towards decarbonizing their activities and being transparent about it. And I think an example of that is Dana Gas. We're a relatively small player globally. I mean, we produce around 60,000 barrels of oil equivalent, but of gas. You know, in a region which is not renowned at the moment for its enthusiasm about climate change and commitments to climate change, although that is also changing very quickly, viz. the COP28 in Dubai this year. But you know, in that context, we have committed ourselves to a policy of measurement rather than estimating our greenhouse gas emissions, putting a plan in place to reduce those greenhouse gas emissions with targets, and then being honest and open and transparent about how we are doing against those targets. We've been publishing a sustainability report since 2017, and we've taken already a number of initiatives in order to reduce our own greenhouse gas footprint. In our Kurdistan region operations, for example, we reduced in 2021 our CO2 emissions by 25%. And we managed to offset the remaining, that's another conversation we can have, of course, but we managed to offset the remaining emissions. So we were actually carbon neutral in those operations in 2021. I think that's the kind of commitment.
Yeah. Okay, good. And yes, we will talk about offsetting, but very quickly on the emissions disclosures. I mean, there is, and I'd like to hear from the others as well on this, but starting with you, Patrick, you know, in the utility sector, this is a stat I've got, only 5 of the top 52 global electricity generators fully disclose their emissions. Oil and gas sector, 15 of the top 27 underreport their methane emissions. I mean, these sorts of, this is backed up by data. It is a real problem, isn't it, Patrick? And it's that also makes the playing field a little bit wobbly for, say, the likes of Dana Gas.
Yes, you know, it's not perfect by any stretch of the imagination. I think the first step is that traditionally the industry has estimated its CO2 and methane emissions, and where people have actually got scientific about it and started to measure their emissions, there has been a realization. And we've certainly been through that journey ourselves. There's a realization that what you thought you were emitting is significantly less than what you are actually emitting once you measure it. So measurement of emissions, both fugitive methanes and CO2, is absolutely essential. And I think people are committed to it in the industry, and there is significant movement in that direction. And we are getting third-party independent verification, for example, of our emission calculations. Not calculations, our measured emissions.
Juan, similar question to you, based on what you're hearing from your clients and what you're seeing from your big clients in the sector, how committed are they really to getting these numbers right?
So look, it's a mandatory thing. So it's what we're discussing before. This is not an option to have not them right. They need to basically audit them and follow some international standards. Okay, so there's no other option for them rather than to get them right. IOCs and all the companies that are listed, they do it. Okay, right now they are very being pushed. National companies, they are also in their way to make sure that those fulfill those international standards, because they are really scrutinized by the public sector, okay, by the public entities. So I think there's no other option, and they are putting all the efforts to make sure that that's happening. Yes, but this is nothing new. Okay, this has already been here for several years.
Yeah. Okay. I'm going to bring another poll up. If we could, just to the organizers, if we could skip poll 2 and go straight to poll 3 on technology, that would be great. I'm going to put this because I want to talk a little bit about technology, and I've got to wary eye on the time. Which of these following emerging technologies identified by the IEA as providing the biggest innovation opportunities for a net zero future will be the easiest to scale up and deploy widely by 2050? We have advanced batteries, hydrogen electrolyzers, and direct air capture and storage. So have a crack at that. And by the way, you can access these polls, I've just been told, via the questions tab at the top of the player. So have a go at that. Whilst you're having a go at that, Masamba, let me bring you back in here. We talked a little bit, we heard from Patrick on some of the frustration felt around the policy side and what's coming from the policy side. As we head towards COP28, to what extent is this going to be addressed? The regulatory issue, the level playing field, making it even for all the players involved here.
Yeah. So the international policies that are set at COP provide direction on where the ambition need to be and what could be done to enhance implementation. It also harmonizes, it provides direction for harmonization of the standards that are used to measure the impact of climate action on the ground. So in that regard, the international decision taken, the international policy making under the COP is an instrument that level the playing field for all the different actors. So the recent recommendation coming from the Achievable, the high-level expert group, is another instrument, particularly for non-party stakeholders, that will allow to harmonize the different standards that are developed to track progress of the non-party stakeholders, corporate, financial, how they are progressing toward net zero. What I would like to highlight here is that what is important, we are not expecting these entities to become net zero now, but what we are expecting from them is to be aligned now with the net zero pathway. And so it means that there is a trajectory that will lead to net zero by 2050. We are expecting these entities that have committed to be net zero by 2050 to be aligned with the pathway that is going in that direction.
Yeah.
So
okay.
Go ahead. Yeah. If I may, you have raised the issue of technology, and you have provided some technologies that are extremely forward-looking and important. But I would like to add one, which is, in my view, also extremely important. These are the digital technology. The digital technology are extremely important because they have the capability to facilitate transformative change, particularly at the use side, at the consumption side, which is extremely important. We need to be aware that the most renewable among all forms of energy is the energy that is not used actually. So leveraging the digital technology to reduce the use of energy is the very first step.
Yeah. Okay, Masamba, thank you very much indeed. I'm going to bring you the results to that poll, the technology poll, in just a moment. But Ibukun, just very quickly, in your intro, you talked about green bonds and taxonomies and the regulation. Just very quickly, want to get your insight on to what extent, how successful in your view the regulatory oversight is over net zero claims, how we fix this pervasive issue of greenwashing, et cetera, et cetera. What's your headline thought on that? Yeah.
Apologies.
Got you.
I think the issues here are there's a huge issue around sort of greenwashing, as we've said. What is the definition of greenwashing? There needs to be some sort of global framework or understanding of what greenwashing is. So in fact, a greenwashing taxonomy in effect. But I think all of these things can be alleviated, Axel, specifically by things such as mandatory disclosure. So good work being done at the moment by the International Sustainable Standards Board. They're going to be finalizing their 2023 initial framework. There's a huge importance, points that both Patrick and Juan have touched on robust sort of transition planning. So in particular, work around what the sort of transition task force transition plan task force is doing. And we really, really like that sort of approach. And it's really creating some accountability and governance issues for companies and corporates moving forward. But I think having a very, very consistent and harmonized framework of reporting that will come in through, for example, SFDR and later the CSRD will definitely add to those to the robustness of the markets, and I think provide the level of confidence that's needed moving forward.
Yeah. Okay. Good. Thank you. All right. Here's the result to that second poll on technology. Advanced batteries comes in as the most important as far as this, or at least the easiest to scale up and deploy widely by 2050 was the question. Advanced batteries followed by hydrogen electrolyzers and then direct to air capture and storage. Juan, what excites your clients? I mean, you talked about CCUS, but what excites your clients most in terms of the technologies?
So look, I mean, in terms of, I mean, the technology that you have put, some of them, they have some limitations in terms of, you know, the availability of material, okay, which is what's going to limit the batteries. And some others are the cost, okay, which is the electrolyzers, okay, which is a different kind of limitation. One. Here, look, what people are very excited right now, and people are already speaking a lot, is the hydrogen. Okay, I think this is something that is everywhere in Europe. There are strong plans, etc. The problem here is to make it competitive. Okay, to make it competitive, two ways. Okay, there are two ways to produce clean hydrogen. One is, well, three ways: clean, blue, which is with gas; pink with gas plus CCUS; pink with nuclear. And the green is heavily uncompetitive right now. Pink could be competitive, okay, because you basically use the electrolyzer quite a lot, okay, a lot of hours. And then the blue, it's okay, but you can only do in a very few places in the world, and then those places are not linked where the demand is. So it's very complex to transport the hydrogen. Is there, but there are strong challenges, okay, there. But I think the one that everyone's speaking right now is hydrogen. The question is how to overcome the challenges that we have in terms of cost and transport.
Sure. Okay. Well, let's put that to Patrick. You know, clearly, hydrogen produced from natural gas is going to play a significant role in the use of natural gas in the future. What are the biggest challenges, Patrick, as far as you're concerned, and can we overcome those in a timely fashion?
Well, in terms of hydrogen specifically, the challenges currently is cost. So as an example, Saudi Aramco took the challenge and took the plunge of investing billions of dollars in a blue hydrogen manufacturing facility in Saudi Arabia, probably the cheapest place on the planet that you could do that. So that was hydrogen from methane plus carbon capture and storage, and the cost is $250 per barrel of oil equivalent. If you talk about green hydrogen, it's double that. Now, those costs will come down. We've seen how costs have come down in the renewable space, and those costs will come down. But there is a huge current gap. And when Saudi Aramco went out to its customer base in Europe and said, please, would you buy our blue hydrogen? They said, no, it's too expensive. So, you know, there is a huge disconnect at the moment between the rhetoric around hydrogen going to be the solution for the future and where we currently are today. Now, we're going to have to get started because we have to go drive down that cost curve. So we're going to have to do it, but it is a huge challenge ahead of us. And then as Juan has indicated, you know, hydrogen is not energy dense. So moving it around the planet is very difficult.
Yeah. Okay. So that's I get from your response, and correct me if I'm wrong, that's probably not at the top of your list. What excites you most in terms of technology then?
Well, I think carbon capture and storage is clearly something. If you replace coal-powered power stations with renewables plus gas, you get a 70% reduction in CO2 emissions. If you add a little bit of battery stabilization to that, you get 80%. Of reduction in CO2 emissions. If you were to replace the entire coal, fired electricity generation worldwide, you get a 15% reduction in CO2 emissions. This is a huge, this is a huge advantage, and this is technology that's there. It's known about. It works. If you combine that with carbon capture and storage, you get 100% CO2 emissions. Carbon capture and storage is a known technology. We can do it. It's just a question of making sure that the right policy decisions are in place to incentivize it. And that really is putting a price on carbon.
Okay. I want to talk a little bit about offsetting, and actually, Patrick, I'm going to stay with you, and then I'll come to the others. But on this, what many people say is an over-reliance on offsetting schemes to compensate. How much of your footprint at Dana are you offsetting to claim neutrality?
We're offsetting all of our CO2 emissions currently in the Kurdistan region of Iraq, where we have more than half of our current production. So that is being done through carbon offsets. We have spent a lot of time and effort carefully sifting through the available offsets that are out there, and it is a very difficult space to be in. It's because you have to really read the fine print to really find out whether the offsets that you are purchasing really are additive in terms of CO2 emissions. And
yeah.
It is again coming back to Ibukun's comment about reporting standardization and verification of carbon offsets vehicles is something that's really needed urgently.
Is Juan, is it? I mentioned when we did our pre-chat, a conversation I had with Scott Kirby over at United Airlines, who very famously calls offsetting a fig leaf for CEOs, which is noticeable as it comes from the CEO of an airline. Is it a fig leaf for CEOs? Do you think offsetting?
It is. Sorry, can you repeat that, Axel?
A fig leaf, something to hide behind, if you like.
Well, it's so look. I mean, this offsetting, they come with a target, which is basically reduce or offset the emission that cannot be technically or economically offsettable. Okay, let's put it that way. Okay, now are they being used for that, for the things that cannot be really reduced, that CO2 that cannot be really reduced? Okay, technically, the reality is not. Okay, the reality is that they are widely used right now for emission that you could actually be reduced with existing technology. So it is. It depends also, the type of offsets that you buy. Okay, the prices of offsets varies from $1 to $20. Okay, depending on the quality, which is linked to what Patrick was saying before, that you try to buy this, and there's a lot of different options there in the market, which is very difficult to navigate. But at the end, look, I think there's a vehicle, but I think that vehicle need to be limited. Okay, so you cannot offset more than, I would say, 20-30% of your current emissions. If you go beyond that, it means that you are basically offsetting things that you should offset with another, or you should reduce with another technology, at least in the long term.
Masamba, I know you've got to shoot off in a couple of minutes, so I want to put one final question to you before you go off, and we have had some questions in from our audience as well that I'll put to the others. Voluntary carbon market, that's gained pretty considerable traction over the last years. There have been issues with integrity, and I know we have this Integrity Council for the voluntary carbon market looking at that. What's your opinion, very quickly, what's your opinion on VCM, and where do you see it headed in the coming years?
So the voluntary carbon market is needed to complement the compliance regime, as it is enabling companies and individuals to reduce their carbon footprint by offsetting a part of their emission that is not subject to carbon regulation. So it is absolutely needed. But for that, it must ensure environmental integrity to play the role that it is expected to play. So in relation to the net zero accountability, both the recommendation of the HLEC and the ISO International Workshop Agreement dealing with net zero recommend to first reduce. I think this is the point that was made by Juan. It is important to mobilize the full potential of emission reduction first, and then avoid. We need also to mobilize the full potential for GHG emission avoidance, and then only what cannot be reduced and cannot be avoided will be offset. And it should be really minimized, because otherwise it will not work, because the amount of offset that would be required to address the global demand would not be available, even if trees were planted everywhere on Earth. So to ensure that we have the full system that is integral, we need to ensure transparent and robust accreditation system for the third-party verifier, and a systematic use of this third-party verifier by activity developer, and then the harmonization of conservative standard and methodology to measure the offset, and the digitalization of methodology also to enhance the objectivity of the assessment of carbon credit and the claim. And finally, the digitalization of the activity cycle to also shift cost and complexity away from the activity developer. So this is important to make it attractive so that everybody can participate, but at the same time, this is important to make it rigorous and ensure environmental integrity and credibility.
Yeah, Patrick, I saw you nodding. Do you want to just add something on VCM?
Yes, and I think the point really is that that you need to have this accreditation system in place because without it, it is a minefield out there. And I think on the point of greenwashing, no doubt there are some bad actors out there who take the easy path. I think really a lot of the greenwashing accusations really boils down to the fact that there are so many different reporting standards, and unless and until we get a common reporting standard that people can be held accountable against, then I think it's going to continue to be a difficult space.
Okay. Look, let me. As I said, we've got some questions coming from the audience, and I'll try and wrap these into the final poll that I put up. And I want to put up that final poll now. Here's the question: what future challenges pose the greatest risk to the successful transition to net zero? A, new energy security challenges that may emerge during the transition. B, projected growth of the population from the current 8 billion to 10 by 2050. And C, projected increase of urbanization to 2/3 of the global population by 2050. So have a crack at that, and we'll take a look at the answers to those in just a second. A question comes through, I guess, very much related to this. What effect will the upcoming recession have on achieving net zero? Will we be able to build back better? Juan, what do you think?
So look, the recession has been very short. So at the end, we are back to normal. Okay, I think one thing that have changed at least, which is, I agree with Patrick what he said before, with the bad policies of the European. What have changed, I think, is the war in Ukraine is going to change the energy landscape, and there's an option, okay, that can push even further or faster the green developments in Europe and developing, investing more in green hydrogen. So that's an option that I see. The recession, all this issue with the COVID, I think in the medium term, I don't think they're going to have a huge impact. And let me add just one thing of what Patrick said before on the having a standard. I think having a standard and a global CO2 price, it's something that would immediately help this. Okay, so the impact of having an import price in Europe to goods that are being imported to Europe, that has an immediate effect, okay, on the industries around the globe, okay, on having that, take that into account, okay, related to the, sorry, I wanted to just to say that because.
Yeah, no, okay. No, but I guess the question, and Ibukun, I want to get your views on this, but Juan first, given the context, the economic context, I know it varies where you are in the world, but the overall economic context, given the energy security issue, and we heard from Putin yesterday, and it doesn't really seem like there's an end in sight. I want to get your headline thoughts on the economic case for the transition. Whether you really feel it's getting stronger, or whether you think it's being put on hold right now. How should a climate savvy investor invest in the energy sector?
So at the end, what we need to acknowledge is that the energy transition is going to be costly. Okay, it's going to be. We need to invest money, and the cost of energy is going to be higher. And people, they need to understand this. Okay, to understand that the light would be, more expensive, etc. It's obviously, the energy, a recession would impact this. Okay, but could impact in two ways. Okay, it's true that there's a high, increase of prices now, okay? But with this high increase of prices, putting on top some regulation of CO2 could be the right timing, actually, okay, if I may, because proportionally is not going to be that impact, okay? Second thing, I think that we need, in Europe especially, think about security of supply, okay, and put a price to security of supply, okay? I think that's a very important thing, okay? We are under security of supply, so when we develop renewables in Europe, that are renewables that are in Europe, okay? And these are power that is not linked to any external company, okay? Also, having more long-term contracts in gas, I think it's a fundamental issue topic, okay? With multiple suppliers, okay? Right now we have, overall in Europe, 2 gas suppliers, okay, mainly in the past, and now we are, moving ahead. So I think that could be actually an angle, okay, that it could be even in the current situation of economic crisis and high prices, to push further the green development. I honestly believe it.
Yeah, okay. Very quickly, here are the results of that poll, and I want to get some 30 seconds from each of you on a wrap up. Projected increase of urbanization is seen as the biggest threat, followed by new energy security challenges, and then population growth. Ibukun, I mean, you talked briefly about where investments in renewables are going. How does the impending recessionary context change that, do you think?
I think the issue here is about finding diversity of sources. So diversity of sources of energy, both geographic and type, and also presenting more, I suppose, diverse offset opportunities. And on that very last point, the levelized cost of electricity in key emerging markets is significantly less than in the developed world. There's a significant opportunity for investment into those parts of the world to create not just a built back better society or economy, but a built back fairer one. And the opportunities ultimately for investors of all types to go into emerging markets, stop urbanization in terms of creating electricity security, energy security in those countries are deeply important. At the same time, creating a lot of impact and meeting SDGs in that sense. So there is a huge societal impact opportunity if we think about us as a global economy as opposed to individual ones.
And then final comment from you, Patrick, if we could. Is the conversation we're going to have in 5 years' time going to be that much different from the conversation we've had this morning?
I hope so. I fear not. I think what we really need to realize is that it's not a question, it's not an option to accelerate the energy transition. If you are committed to the objective of net zero by 2050, we have to. We have to deploy more renewables at scale, and we need to complement those renewables with gas as opposed to coal, because we need a base load, and then we need to combine that with carbon capture and storage to deliver a net zero solution. But I think it's very hypocritical of the EU to prevent, or to try and prevent, Africa from developing its own gas resources, given the energy poverty of that continent, particularly in sub-Saharan Africa, and at the same time subsidize their own consumers to the tune of 500 billion euros last year, and having the developed world as a whole having already used up 2/3 of the carbon budget that we have. So I think that there really needs to be some joined up thinking about how we transition faster to a fairer future.
Yeah. All right. Look, and then on that note, I am going to stop there. And I wish we could have delved into that issue more deeply. We'll have to save that for next time. Look, thank you very much indeed to Patrick Ullman Ward, Ibukun Adebayo, Juan Vasquez, and Masamba Athioy for your insights and your candor today in our discussion. Many thanks to everyone who joined us for this webinar series, supported, of course, by the Al-Attiyah Foundation in partnership with Refinitiv, which is of course an LSEG business. Do fill out the post-event survey, which is on the same event page. Thank you again to all of our speakers. We look forward to seeing you next time.